a live streamer, an influencer outside of a hot chick wearing modeling clothes, she can do it overnight. But guys, in order for us to turn a podcast into something that's going to be long lasting, you're looking at 5-10 years of investments into that. You're looking at regular occurring adjustments and fine tuning and a lot of effort to build it into something that's going to be self-sustainable. And self-sustainable means that it pays for its own operation costs. That's self-sustainable. That's not even turning you a profit. You understand? So AC said, thanks, Confucius. You're welcome. Assidious. I love when the hecklers come in and they're slick. But either way, make sure that you guys take the time to throw your comments in as long as they're appropriate, because we do got some gentlemen that are in here, some youngins that are in here that are not quite of the age of 18, and we want to make sure that we keep things clean for them. Also, if you're commenting from Twitter or Twitch, your comments will also be seen up above the way AC and Michael's comments have been seen up above, because we put up the appropriate comments, not the inappropriate ones. When they start getting inappropriate, I stop putting them up. And when they start getting too appropriate, I ban the person from the channel altogether. So first warning is that if you didn't see your comment go up there. Second warning is I got to talk to you about it. And then after that, that's it. Then Michael says, you never spend your principal. You use your OPM, which is other people's money, which is what we were talking about yesterday with loans. Utilizing other people's money to get what you need, and then generating enough revenue where the interest off of the investments that you have is larger than the interest off of the money that you borrowed. And the difference is your profit, where you're ultimately gaining wealth from your assets, you're gaining new assets, and you're using other people's money to do it, which means that you personally can be broke as fuck because your assets pay for everything and other people's money pay for everything else. And the difference between all the other people's money you got to pay back versus the assets that you have is going to give you a $0 on paper income, which means you don't pay taxes in a legal fashion. Michael says, so what if you're under 18, but we can send you to war? Haha, that's true. Actually, you notice under 21, the certain states have a requirement where you have to be over the age of either 21 or 18, depending on the state, to buy alcohol, cigarettes, and play the lottery. More often, they're saying that you got to be 21. Also, with the purchase of certain types of firearms, you got to be 21. However, with new laws that have changed, they are now allowing First Amendment concealed carry, which is like small handguns, where individuals that are 18 can go and grab a firearm. But you can go to the Army get enlisted at like 17 and a half, 18 years old or whatever, do 2 years in the Army, come back and still be 1 year too young to play the lottery, still be 1 year too young to buy alcohol at the bar, still be 1 year too young to buy cigarettes in certain states. But you can die for your country before you're 21. You just can't get any of the benefits of being an adult or a patriot until you're 21, which I think they should either make an exemption for your military ID, or I believe, oh yeah, you're too young to smoke, but you're not too young to die for your country. I believe that once you go to the whatever with a military ID, like that should be your clearance to get in and do what you got to do without having to have those restrictions. But you know, hey, it's a fickle world we live in. For every law that says you can do it, there's like 5 laws that says that you can't, but each law is circumstantial. So it really depends on your situation, and it depends on what decisions that you make, which is why on Thursday, Fridays, and Saturdays, we talk to you guys about making better decisions. Now, I know a lot of y'all came in today so that y'all want to hear and talk about stocks, and I want y'all to hear and talk about stocks. So let's go ahead and dive into this real quick, guys, because most investors are told that they should be happy with the stock market historically having a return, which is about 10% a year. And a lot of people like Tom Jacobs, and Brett Owens that gave us the book about retiring off of 8% and living off of 8% is telling you that, to be safe, worst case scenario, you can run around with 8% dividend return on an annual basis. Michael said, did I say, not do as I say, not as I do, buy stocks? Well, I say buy stocks. Now, you can also buy cryptocurrencies, ETFs, and stuff to that effect, but I definitely say buy stocks. However, after you account for the inflation that's closer to 7%, and that 7% is held up by gold standards, right? What if that number is actually holding you back, especially if your goal isn't just a big number in an account someday, but a real cash flow now? That opportunity to gain 8 to 10% return, knowing that we have about 7% between taxation and inflation, you're not going to be walking away. In order for you to walk away with 8 to 10%, you got to be hitting 16% interest. So what if I told you that it's possible to construct a portfolio right now today that generates a 27% yield, paid cash dividends? Look now, for a long time, I was on that same treadmill, chasing those single digit returns, working for the man, and it doesn't work. I felt like meaningful cash flow was decades away. And then we started doing the math. If you're looking at a $100,000 portfolio earning 7%, you get $7,000 a year, which is horrible. And that's before taxes. That's a nice little bonus, but it won't pay the mortgage or replace your income. So I was at a crossroads, either accept that financial freedom was a distant dream or find another way. So I decided to find another way, because things change when we stop listening to the conventional wisdom that automatically labels anything with a high yield as too risky. There's no such thing as too risky. You just can't afford the risk. It changed when I started hunting for the dividend powerhouses the rest of the market ignores. So in today's show, I'm not just gonna tell you it's possible. I'm gonna show you exactly how to do it. So I'm gonna be pulling back yet another curtain, and we're gonna be doing it on this type of stock. And these are gonna be stocks that I also own. So these strategies, you can find them and the critical rules that I follow to manage them very simple, but they do have some real risks. And we're going to be managing those risks. This is a step-by-step guide to building the high cash flow machine. So first, let's take apart the core belief that holds most investors back. That obsession with the market average annual return. Now, let me be clear. The S&P 500 is not a bad investment. If you want a passive long-term growth strategy and don't need to touch the money for 40 years, it's a proven winner. But many of us don't have a 40-year runway. Or main goal is to create a steady income stream today. There's my man. Special shout out to Steven from Twitter X. What's up, my man? He said, I missed last stream. We locked in this week. I've got most of the week up there, actually up until when? No, actually, I got it all the way until Saturday, now that I think about it. So you can hit the notification button on all of the shows till Saturday, and that'll let you know so that you can jump in on Twitter the way you jump in on Twitter. But it's good to see you, because we haven't started talking about the stocks, but we will be doing it today. So make sure that you come through. Oh, Steven, real quick, make sure that you go and grab Arbor Realty. Arbor Realty Trust is ABR, which is different from AG Management, or Armor Realty is the different one. But Arbor Realty, ABR, is the one that's supposed to be wrapping things up on the 15th of this month. The stock is on a steady incline, has been on a steady incline. Let me double check the Arbor Realty Trust. I want to make sure that I'm quoting you the right one because I got them out there. ABR, that's right. Arbor Realty Trust, ABR. That's the one that's going to be hitting on the 15th. And it's pretty low. It's really close to $11.88. Y'all see the tickers going across the top of the screen. If you pick up that one now, this week, tomorrow morning, by next week, that's right, ABR. Yeah, I put it into this. So hold on, let me go back up because I wrote it, and I wrote it correctly. Arbor Realty, the ticker is ABR. You go grab that one and you'll be able to ride the wave between now and next week. Now, one of the things that we noticed on Zimstock last week is that the ex-dividend value far exceeded the stock price far exceeded the ex-dividend value. So some people were able to sell 5 days before the ex-dividend date. Then when it dipped on Tuesday or Wednesday, they were able to buy back in and still get the ex-dividend. So by getting a few $100s off of the difference in the increase because we owned it 2 weeks before the ex-dividend date, and then still being able to sell it again and buy it back before Friday. So we had it when the ex-dividend was on Saturday. Come Monday, we were able to sell it. It bounced back on Monday. So it was still up in comparison to the 74-cent dip. So we got 100% of our ex-dividend and a few $100 extra off of the difference in the sale. For those people who didn't sell, you just got the ex-dividend. But that's fine because you did not take a financial loss. Either way, you follow my lead. I'm going to keep giving you guys information so that you know how to dive in and get it when you can. Michael said money only serves as a transaction between you and the person you are fleecing. 1179. See, now I said it was 1188. Michael's got ABR at 1179 right now is what it's quoted at. So if you go and grab it, I picked it up at 1155 earlier today. So it's still rising. It's still rising. And it looks like, because usually around this time, it continues to rise up until the ex-dividend date. And then there's like a 30-cent dip. So if you buy in and it takes that 30-cent dip, if you buy in now, but it gains another $1 before next week, Thursday or Friday, and you catch that 30-cent dip, it's still going to be higher than what it was when you bought in. So that means that you're going to have a fantastic improvement in your ability to gain dividends from the stock and still gain a difference in the share price, which is better for us because we don't want to break even between our share price and our dividend stock. Now, moving on to what we're talking about today's portfolio, though. The 10% figure that everyone always hears about is the total return, which is a mix of stock price appreciation and dividends. For the S&P 500, the dividend part is pretty small, currently floating around 1.5% payout. So to get that return, you are almost completely dependent on stock prices going up. And to turn that gain into cash, you can actually spend. You have to sell your shares, or like we were talking about yesterday, taking cash loans against the value of your portfolio to prevent from liquidating your assets. So if you think about that for a second, if you own a rental property, would you sell the bathroom every time you needed cash? Of course not. You'd use the rent checks. So the whole point is to own the asset and live off the income it generates. And that's why we're trying to find high paying cash stocks that have low buy-in values, which means that your per share investment is higher and your cash dividend payout is higher. So you're going to buy in less. So like, for example, Orchid Island that we're going to be talking about later this month is still under $8 a share. You buy that boy and it's giving you 12 cents a share, which is almost 18 or 19% interest off of it. you could buy 8,000 shares of that far cheaper than you can buy 1,000 shares of Tesla. You can probably buy that far cheaper than you can buy 100 shares of Tesla. But Orchid Island is paying 12 cents a share. So if it's paying 12 cents a share for every 1,000 shares you have $120. And that's per month. That's not per year. That's per month. That's a monthly payout. So why do we look at our stock portfolios differently in today's show? Well, this is the fundamental problem for anyone who needs a cash flow if they're not paying attention to what we're talking about right now. When you have to sell shares to generate income, or even if you're trying to take a cash loan against the, yeah, exactly, cost per share. So you're looking at what is called the P&E, the profit that you get versus the investment. The money that you're supposed to get back should be reasonably higher than the money that you got to put in to get it on a regular, because otherwise it's not going to be feasible for you. Now, what I've looked at is that there's a lot of stock options. Even if it's like, a $500 stock that's giving you $50 per share, it's still around about 10% payout when you're doing dividends on some cash dividend stocks. But the lower stocks, if you're getting $50 a share off of a $500 stock, but you only got $500, that's not the same as 12 cents a share for something that's under $10 a stock, where you could get almost the same amount of money or more off of a smaller stock because you're going to have more shares. This is one of the things that we pay attention to when we're talking about how to adjust this. So if the market crashes 30%, like it did earlier this year when it dropped 700%, because it has done this before, and it's going to do it again, you're going to be forced to sell more of your assets or bargain against the assets at a basement price where you're not going to get the same amount of cash for the value of your portfolio. It's a downward spiral that eats away at your capital right when you should be protecting it or buying more. So then there's the slight killer of inflation. And if you have inflation that's humming along the areas of 3%, your 10% average return is really only 7%, which is why Brett Owens was talking about 8%, because if you're averaging 15% and you're taking a 7% hit, that's going to leave you right around 8%, which is 3% for inflation and about 4% on taxation. They did the calculations in some magnitudes. But after you pay taxes on it, the number gets even smaller. So the math starts to look pretty bleak, and you realize that the conventional path is a slow grind that might not even keep up with your cost of living, let alone give you real freedom. So I needed a strategy that didn't depend on market swings or selling assets or having to leverage assets for cash loans. I needed a portfolio to work like a business, depositing cash into the account every single month, whether the market was up or down. This takes complete mental shifts from focusing on total return to focusing on the cash flow. It's about being an owner, not a trader. Remember yesterday we were talking about being an owner, not an earner, being the guy who owns everything, not the guy that does everything. Now we're talking about being an owner, not being a day trader. I mean, we're doing a dividend rotation strategy so that we can get 3 times more returns or more, because if you hit all of the values on a dividend rotation strategy, you can get yourself up to 168% return. And we've shown that the stocks that we've been tagging on while the market is on the rise has clearly been showing us more than meets the eye as far as dividend returns. But even if you just get the basic levels of a lot of these stocks, you're looking at seeing something close to, if you don't hit all the stocks, at least 75% increase, which is 3 times more than what you were getting. So a quarterly, hitting a different group of quarterly stocks every month means that you're going to get 3 times more payout each month off of the dividend rotation strategy instead of only getting that payout once every 3 months or relying heavily on just the monthly stocks. Michael says, build a cash stream. Sometimes your stream may dry out for a while. Yeah, you're right. You're right. If that stream, your stream will dry up for a little while. But you also have to recognize that when you know that your stream is not as good as it could be, you want to be able to put enough effort into alternative methods to make sure that you can increase the flow. You want to be able to have a backlog of finance so that when the stream starts depleting, that you still have a steady pond to dip into until the stream comes back. You don't want to be living paycheck to paycheck, even from your investment portfolio, because if the investments start to decline, the payments start to decline. And if you don't have enough money this month and you're not going to get another stack of cash for another 35 or 45 days, you're not going to have enough money to pay your bills this month. So you have to have a different mindset. Now, the road to a 27% yield doesn't start with a stock screener. It starts with changing how you think about your money. So most people are growth investors without even realizing it. They buy a stock at $100, hope it sells later for $150. Any dividends they get is just a small bonus. Their entire game plan is based on selling the assets in the future, which is growth stock mentality. When we're doing a dividend rotation strategy, we're trying to get 3 times more shares off of each stock investment that we invest in, because we're hitting quarterly stocks on a monthly basis, which is giving us 3 times more dividend. We are still depending on growth, because as it grows, we're going to get both the sell value and we're going to get the dividend value, which gives us 2 levels of gain. Or we break even on the sell value and we still get all of the profit from the dividend, which still gives us a gain. Where 2/3 of the time you're at a gain, 1/3 of the time you break even. Well, hold on. 50% of the time you're at a gain, 25% of the time you break even, and then the other 25% of the time you might be at a loss if you're not paying attention to the stock values. Michael says, spread your basket with different stocks. That's called diversification. Now, a cash flow investor, or what I'm going to call cash flow capitalist, plays a different game entirely, because we buy a stock for the income stream it provides, not what the main goal of selling is. So even if you did not sell Zim stock on Monday of last week to get that extra $230 off of the stock and then buy back in so that you can get the ex-dividend, you got the ex-dividend. And if you sold, like I told you to sell on Monday, then you got the ex-dividend at a surplus, and you still did not have to take a dip with the loss because it balanced out by Monday. What we do is we look at the stock the same way real estate investors look at an apartment building. The day-to-day paper value of the building doesn't matter nearly as much as the answer to one simple question: are the tenants paying their rent? How many doors you got in real estate don't matter unless the tenants are paying the rent. For us, dividends are the rent. We're buying a piece of a business, and as owners, we have a right to our share of the profits. So the goal is to collect as many of these rent-paying shares as we can to build a river of passive income. This is passive because we're doing very little, if no work, because you come to me and I give you all the information. So I did all the work. And then you're going to go out there and you're going to invest in it, and then you're going to benefit from it. So you put your money into something, you leave it there, and then it starts paying you while you're asleep. That's fantastic. This shift does wonders for your psychology. When the market panics and prices fall, the growth investors is staring at a portfolio drenched in red. Their net worth just dropped. Their strategy is in shambles, and fear takes over. The cash flow capitalist, on the other hand, sees an opportunity, because as long as the companies are solid and keep paying their dividends, our income is still safe. how much you get per share is not going to change whether your share is worth $5 a share or your share is worth $500 a share. So when the market tanks, as long as the company keeps paying you your dividends, your check is still the same. That's going to be the difference between growth stocks and cash stocks. And if you're holding cash stocks and taking out equity lines of credit against your cash stocks, if the market dips and you're still getting a residual paycheck, you can pay on those market loans, those cash loans that we were talking about yesterday, and put it towards lowering the difference so that they don't have to subjugate your assets. You also want to make sure that you don't borrow more than what you need. That way you don't have to pay so much back. Michael says that's a good way to look at it. Got to tell you, we're coming from left field with unorthodox ways of looking at life. But in fact, a market crash is the best thing that can happen to a cash dividend payer. Why? Because our dividend cash can now be reinvested at lower prices, buying even more shares. And it's like a Black Friday sale on income producing assets. Every dividend dollar now buys more future income. This is the dividend snowball effect on steroids. Y'all got to pay attention to this. Now, this approach makes you think like a business analyst, not a market speculator. So you're not going to be just observing it. You're going to actually be analyzing it. You stop asking, will the stock go up? And you start asking, does the business make enough cash to keep paying me? That's the most important part. Is the dividend safe? Is management shareholder friendly? You're no longer betting on market sentiment. You're investing in the cash generating power of real businesses. Now, once you see your portfolio as a collection of cash machines, a whole new world of high yield investing opens up. So we're on earth to do it in a way where you're going to be finding stocks paying 15% to 20% or even more. Not in the S&P 500. Blue chip companies like Apple, Microsoft are very amazing stocks, but they reinvest most of their cash to fuel growth. So their dividend yields are low, if not obsolete. So to find the income heavyweights, we have to look in specialized corners of the market, sectors designed specifically to pass income through to investors. So there are three main habitats for these high yield monsters. Business development companies, or BDCs. I'm going to give you that so you know where to look. Business development companies. And make sure that you guys take the opportunity to like and subscribe, and also make use of those reaction buttons that they have on the screen there. I give this over to the guys over on Twitch because I share it with everybody. So Twitch and Twitter is going to have it. Twitch and Twitter is going to have it. YouTube's going to have it. Michael says, start looking at life from being the owner instead of servient. That is a very fantastic way to talk about it, because if you I used to say back in the day that my mom raised a slave when she raised me, and the reason why I say that, and I say that, people are like, oh, that's deep, but it's a real thing, because you have to look at the fact that, hold on, it's about to start acting funny. I said it, and then it happened. I was like, just as sure as I seen that thing flash across the screen, I'm supposed to be getting the software update coming soon on it. But like I was saying right before everything started going down, I was saying that my mom, I used to say that my mom raised a slave when she raised me, and people are like, "Whoa, that's deep." And you got to understand, it's a true thing, because servient mentality is being a really good worker. You're putting all of your body into this job. You're putting all of your thought process into this job. You're putting all of your physical effort into this job. You go home thinking about how you can be better at this job. Everything you do revolves around this job, right? Even on your days off, if the job calls you, you're dedicated to the job. Strange, right? Servient mentality. You want to be the best worker the job has ever had. Servant mentality. We don't want to do that. Instead, we want to be owners. We want to own the business that everybody's working for. We want to profit off of the effort of everybody else that is getting paid off of our success. So we don't have people riding our coattails for free. They're earning their keep, but they're earning their keep and they're putting money in my pocket at the same time. That's the mentality of an owner. It's not the same. And one thing, when we change our mentality, when we change the way we do what we do, that's when we start experiencing a better way. Yet we're going fishing. That's right. We're going fishing. We're going fishing off of a super yacht in the middle of the ocean while everybody else is grinding out on a holiday, getting overtime, time and a half for working on a holiday. We don't work during the week, much less on a holiday, because we get paid to stay at home. That's what owners do. So you got to think about that. You got to make someone else's life better when you're a servant. Everyone else is making your life better when you're an owner. You got to think about that. Now, let's keep going. The business development companies. You want to think of BDCs as banks for small and mid-sized private companies. After the 2008 crisis, new rules made it harder for big banks to lend to these businesses, and BDCs stepped in to fill the gap. They make loans to and sometimes buy ownership stakes in these companies. Because the loans are often too small, riskier businesses, they come with higher interest rates. This is where the high income for BDCs come from. By law, BDCs must pay out at least 90% of their taxable income to shareholders as dividends. In return, they don't pay corporate tax income. So it's a direct pipeline of interest payments to your pocket. The risk, of course, is that if the economy tanks and these smaller businesses start to default on their loans, the BDC's income and your dividends can fall. Mortgage real estate investment trusts like Arbor Realty, which is what I was telling you guys about at the beginning of the show. These mortgage real estate investment trusts, good place to get cash from, because this is another place that you see high risk yields. Don't mix these up with REITs that own buildings. Mortgage real estate investment trusts are MREITs. MREITs don't own properties. They own mortgage debt. They basically borrow money at short-term rates to buy bundles of mortgages that pay a high long-term rate. Their profit is the spread between what they earn on the mortgages and their cost of borrowing the money. Just like BDCs, they have to pay out 90% of their income to shareholders. This legal structure is what creates their huge yield, but they are extremely sensitive to the interest rate changes. So just like when the feds were giving a shit at the beginning of the year with the tariffs that just hit China, you've seen all the real estate investment trusts start dropping. When you're seeing California burn to the ground for 45 days, you're seeing all the real estate investment trusts start dropping in March because they had to take all of the profits and rebuild all the real estate. If rates move quickly, their profit margins can get squeezed. This makes them one of the most volatile high yield investments. But you have to know what you're doing here. And that's one of the things that we've been researching over the past year is exactly how do we get in here with the least amount of money and make the most amount of profit. The next one that you're going to see is specialized trusts and other high yield earners. I'm going to tell you this one. So these are the categories that we went through in order to find all of the stuff that you guys are going to benefit from today. This is a catch-all for other unique income-focused investments. Yeah, BDC stocks, $22 per share. See, there you go. But when you're looking at certain, because we have coming up, we have ABR, we have AG Management, which I think that one might be MITT. We have RM stock, we have Cord stock, and all of those are going across the top of the screen, where on the 15th, the 16th, the 20th, the 21st, and the 22nd, we got 5 stocks happening in the middle of August that are all cash paying stocks. And we're going to be talking about them throughout the month. So you guys got to like and subscribe and come back every day to see which ones we're telling you to go grab. High yields and high risks, but high reward because you're riding the volatility. You got to understand, volatility is where stocks make profits. If there's no volatility, nobody's going to get scared and run and sell high where you can buy low. If you're not buying volatility, you're buying bonds because it's a gradual increase. If you're not buying volatility, you're buying CDs because it's a gradual increase. It's never going to dip unless the bank goes under. When you're dealing with volatility like cryptocurrency, you're buying the volatility. But that volatility helps you with gaining more profits. Now, a great example is a royalty trust, and these entities don't run a business. They just own the rights to the royalties on something like oil, gas, or iron, or something like that. They collect the royalty checks, take a small cut for the expenses, and pass the rest directly to the shareholders. So the income can be massive when commodity prices are high, but it can also be incredibly volatile and disappear when prices crash. Understanding these structures is everything. You have to know why a company can pay such a high dividend versus the realisticness of maintaining those dividends. It's not magic. It's a result of their business model and legal structure. When you know this, you understand the specific risks that come with each one. And this is going to be the most important part of the whole game. All right. Now, if you're still following us, this is the part that you've been waiting for. I'm going to walk you through the type of holdings that can power a portfolio with a headline yield of 27% interest. So let me be crystal clear. This is absolutely not a buy list that is officially government mandated buy list. This is the list that I bought. And this is an educational case study. So you can use this list because I stamp my name on it, this and that, where we talk about this, that, and everything in between. But it depends on which trading platform that you use, depends on whether or not you have accessibility to every stock on this list. But all of these stocks are real stocks. You can do research on these stocks. You can make this list yourself and determine how many of them you're going to buy and how much of each one you're going to pick up. So, disclaimer, this is for educational purposes only, to show you how extreme a high-risk portfolio we can build and make the most quantity of profits off of it. But I stand by it, and we're going to be talking about these stocks for the rest of the year. So I'm quoting from all of the research that I've done this month, but it will change every day. So the numbers that I'm giving you right now today might not be tomorrow's numbers, but it's damn close to this morning's numbers. So just go and grab the stocks with the tickers that I give you and do some digging for yourself. Now, the cornerstone of this portfolio, this theoretical, hypothetical portfolio that I live by, that I own, that I'm using right now in my dividend rotation strategy. That's how serious I am about this. The source of this massive yield is going to be holdings like Mesabi Trust, MBS. This is one of the first stocks, and I want to give you this one at the top of the list. So if you guys are following along on Twitter, or if you're following along on Twitch, I'm putting these things in the comment section, but you guys can watch this on YouTube in post replay and get it in real time at this moment. Where are we now? Like an hour into it, 52 minutes in. You can go straight to that 52-minute mark and be like, there's all of the stocks right there. Mesabi Trust, MBS, is a royalty trust, which in this data set is showing a staggering dividend yield of 27.2% as of this week. MSB isn't a normal company. It doesn't mine or sell anything. It just owns an interest in iron ore operations and collects royalties based on the price and value from iron ore shipped. Okay. Michael says, love chaos, embrace financial chaos. People sell at low prices. It's hard to see how you can be broke today. Anybody who's watching the show right now and they still broke next year, that's because they didn't keep watching the show and they didn't do nothing we was talking about doing. That's it. That's it. Because what we doing right now today, what we doing this week, what we've been doing for the last 6 months, what we've been talking about all year is making money, make money for us, giving you ways to put money into your pocket so that you can stop working for somebody else and start working for yourself. Start building more generational wealth, start building more financial freedom from the responsibility of having to go to work so that you have more free time to spend time with your loved ones. That's what we're building right now. Helping men become higher value men, and then the women who know how to click a button on fintech can utilize this to become higher value women. You're less likely to put all of your effort into finding a man with money if you got your own money. Now you just got to find a man that's not going to waste your money, and then you can find you a better man. So this works out for everybody. The hypergamy can go right out the window because she could be a $100,000 a year cash dividend woman, and she can find a man that's a $50,000 cash dividend man, and they can come together and be a multi-million-dollar family like Jay-Z and Beyonce. Controlling the company. That's the goal. Being the owner. You got to control the company. You know, when you start up your own LLCs and your own C corporations and stuff, a family business, doesn't matter what it's about, but it's a family business. You know, part of that business doesn't matter what you're doing with it. Think about the House of Xander. If that was the business, ridiculous, right? Sounds like a dating reality TV show, right? But if the House of Xander was an LLC, and in that business, there was a staff, cooks, drivers, maids, security guards. I could have a whole staff of individuals like MC Hammer on my payroll, except I can afford to pay everybody and not go bankrupt. And then charge off all my taxes, get deductions on my taxes for all of the people that I'm compensating under my business operation. Have everybody stock options, get the healthcare scenarios and stuff like that. Split the shares of the business, have them buying shares into the business that is me. You know, you can do that. You can do that. It's crazy, but you're making money work for you instead of you working for money. That is the only 20-year goal that everybody should have. And figuring out how to get there in the most effective way possible with the least quantity of effort and the most quantity of results is what you're supposed to be aiming for. He says, C Cord is your C money. Cord is coming up. Cord is supposed to be on, I think, the 22nd. The Cord is $106 a share. Now, when steel demand is high and iron ore prices are through the roof, MBS can pay out unbelievable dividends. And this is what can be used to drive a portfolio's average yield into the stratosphere. However, the risk is just as massive. So if a global recession hits or iron ore prices crash, or like the fucking tariffs that stop transportation of it to the United States and stuff, you'll see MSB's dividends plummet. Now, its dividend history isn't a smooth line. It's a series of wild peaks and valleys. Holding a stock like this means you are signing up for the volatility. It's the definition of a high risk, high reward play. And some analysts point to its payout ratio as being unsustainable over the long term. But I love that, because if everybody else is going to run from it, I can go straight there and get all of what's coming to me. Next, a major income component would come from the MREITs sector, which is a stock that I love to give you guys, because Orchid Island Capital, which is part of our dividend rotation strategy, showing 20.4% from time to time throughout this year. And I've been talking to y'all about this one. This is the lowest costing stock with the highest paying dividend, right? And I had to say that slow. The lowest costing stock with the highest paying, and it's a monthly dividend. Orchid Island Capital. That's what you guys need to be looking at. Now, ORC invests in real estate mortgage-backed securities guaranteed by the U.S. government entities like Fannie Mae and Freddie Mac. So this agency backing means the risk isn't that people will default on the mortgage. The risk is all about interest rates. So when the Feds was fucking with interest rates, ORC went from $19 a share down to $7 a share. And now we can go and grab it until it gets back up to $20 a share. And at $20 a share, we would have 3 times more value than what we had when we started, where we would have experienced growth and we would still be getting our 12 cents a share dividend payout. ORC makes money on the spread between what it earns and what it costs to borrow. It pays monthly, which is great for cash flow. However, its history is a textbook example of the dangers here. The dividend has been cut multiple times. So it was, I think, 30 cents a share last year or something to that effect. And then it got cut at January, February of this year, but it's still giving you a monthly dividend. This happens when interest rates shift and squeeze their profits. Now, guess what happens when they switch back, when all the prices switch back? So he's at 712%. Look, he's looking at the stocks that we're talking about right now. I'm telling y'all, these are real stocks. $7.12 a share. What did I mark it at when I was last looking at it? I said 715. See that? See that? 712. So when I marked it at 715, it's gone 3 cents lower than what it was when I was talking about it. But it typically goes down because the ex-dividend date was last week. And it goes down as people sell it between the 1st and the 10th. It actually starts going back up towards the middle of the month, and then it starts going back down again, getting closer to the 23rd. And if you want to get it at its lowest, you either buy it right now and wait the rest of the month, or you buy it on the 23rd when it's at its lowest, closest to the ex-dividend date. You're asking me what's driving this What's driving the downturn right now? What's driving the downturn is because everybody who owned the stock last week Monday or this week Monday, because the first was over the weekend and the ex-dividend was last week Thursday, I think, and everybody started selling the stock between Thursday and last week and today. That's what's driving the stock down, the stock value down. The more people that are buying into the stock are going to buy into the stock and increase the value of the stock. What is going to convince people to buy into the stock is that the interest rates are starting to become more stable since Donald Trump. When I covered the story last month, how him and China dropped the tariffs. And when they dropped the tariffs, they set it at 34% for United States to China and 25% from China to the United States. When they dropped it from the 145% tariff on China and the 125% tariff on the United States, when they dropped it by basically 200% overall between the two, that is what increased the interest rates, the interest rate usage in the United States, because now more houses are being sold. More loan companies feel more comfortable with lending. The lending requirement is lower now. The houses are now being sold less because instead of the materials being god awful expensive, the cost of some of the materials are starting to go down as well. So overall, you're looking at less cost, which allows the buyer to buy more often, which allows for more loans to occur. And the more loans that are occurring, the more interest that's being made. And the more interest that's being made, the more security that the company is showing, and more investors that are looking at the budget of the business and investing based on the budget. Those guys are buying in because they're more comfortable with Orchid Island's position. But that was the reason why 700% of the market ran in April, because they weren't comfortable with the position. And I love that, because when they ran, I dove in. I made over $1,000 off of them running. Now, when you're investing in Orchid Island, this means that you are betting that its management can perfectly navigate the complex world of interest rate hedging. And many analysts consider it a potential yield trap because its high yields is often just the result of the falling stock price. And that's true, because it's 12 cents per share is only giving it the high 18 to 20% valuation because it's currently valued under $10 a share. When it was valued at $19 a share and $20 a share, that 12 cents a share was not as sexy as it is right now. But we're taking advantage of it right now while it's sexy. Michael's saying, I'm looking at the chart over 5 years from $30 per share to today's $7.13 a share. Exactly. Now, if it's been paying 12 cents a share over the past 5 years, that 12 cents a share wasn't as attractive when it was $30 a share for the stock as it is right now in 2025, when it's $7.12 a share for the stock. So when I told you guys that when Donald Trump was going to flip the market on its head, now is the time for us to buy in. So imagine that this stock over the next 5 years gets back to $30 a share. If you continue to buy into it from now till $30 a share, then you will have more value in your stocks, in your shares, and still be getting your 12 cents a share, which is still way cheaper than buying Johnson & Johnson. It's way cheaper than buying Coca-Cola. You're buying more shares at a cheaper rate and getting more dividends off of each individual share than what you are living off of the growth of a growing stock. Because we're not focusing on the value of the portfolio, we're focusing on the cash dividends paid out from the portfolio. That's what's more important. So while it's $7.12 a share and it's paying you 12 cents a share, you want to buy way more. You said, I think overall it will drop lower. Well, I would hope so. If you're following a dividend rotation strategy and you're buying in when it is at its lowest for the month, and then you sell when it's at its highest for the month, it's going to fluctuate over the 3 weeks you don't own it. And there have been times throughout this year that it has gone down to about $6.80 a share, which is fine. Because if we're buying it at $6.80 a share and we're still getting that 12 cents a share, you're still getting almost 22% interest off of each share, because it's not about the value of the stock. It's about the cash dividends paid from the stock. He says, when it sells at 5, I'll buy a block of it. Bro, I'm going to buy a block of it until it shares at 5. I'm going to buy a block of it until it reaches 30. I'm going to keep buying a block of it until it costs more to buy Orchid Island than it does to buy Arbor Realty, AGNC, and AG Management, which are all cash stocks. Now, here's another one. To diversify your portfolio, I'd look to business development companies. So a key example of this one is going to be Oxford Square Capital Corp. So I'm going to give you this one. And y'all follow along, because Michael can tell y'all, yep, these stocks do exist. These are some real cash stocks. And what we're talking about is what it is. People overlook these. This is what you're calling an undervalued stock. People overlook these stocks because of the price, because of the volatility. They're overlooking these stocks because of the dividend payout. But these stocks are sexy stocks to get your hands on, especially for those individuals that are just starting out trying to achieve gain. Oxford Square Capital Corp, which is OXSQ, is yielding at 18.3%. And the investment is in debt of private U.S. companies, mainly through complex instruments called collateralized loan obligations, or CLOs. In simple terms, they are lending to businesses to generate high income. They also pay monthly, which is a feature that I, for one, love for a cash flow strategy. The main risk is credit risk. If the businesses they lend to start struggling in an economic downturn, they won't be able to pay their bills, which hits OXQS's income directly. Only way it will change is if the federal makes changes. But that's the thing. So because they're depending on interest and loans and mortgages, the only times that they really get hit is when the feds make a change. And the feds usually make changes when tariffs happen, when trade wars occur, when war and conflict between countries in the United States, where the United States get in other people's business, occurs. That's when the feds start making changes to the interest rates. So if the feds don't make changes, or if the feds make changes in the interest of consumer favoritism, then we start seeing better results. And when we start seeing better results, companies that are structured off of profits from interest, from mortgages, loans, and other such, they're going to make substantially large quantities of capital. And then all we've got to do is just hedge that. Now, another BDC example is Prospective Capital Corp. Here goes another one. Now, I want y'all to understand that I started from the highest stock interest yield, and I'm working my way down. So the first one I told you is pushing out 27%. We've gone down at 20%. Now we just crossed over 18%. And now at Prospect Capital, we're looking at 15.93%, where PSC, make sure y'all like and subscribe and utilize those reaction buttons. PSC is one of the oldest BDCs and lends to middle market companies across many different industries, which helps spread out its risks. Like the others, it also pays monthly dividends. So we just stacked on a whole quantity of stock options that would pay monthly. One of them, I think, pays quarterly. I think the first one that we talked about pays quarterly, but the rest of them are paying monthly. These risks are similar to OXSQ. Its performance is tied to the health of the U.S. economy. While it has a long history, PSEC has also faced scrutiny and has cut its dividends in the past. While looking at a BDC, you have to check its non-accrual rate. That is the percentage of its loans that aren't being paid. If that number starts ticking upward, it's a huge red flag, which also gives high-level investors the sign to sell, which means you'd be selling at its highest level. Finally, to round out the M-REIT exposure, we got plenty more to talk about, but to round out the M-REIT exposure, I'd hold a position in one of my most favorite stocks, AGNC Investment Corp and Two Harbor Investment Corp, which are two of the stocks that are in our dividend rotation strategy. You see them at the top in our ticker levels. These guys are yielding at, AGNC is at about 15.57%, and Two Harbor is about 16.9%, both primarily investing in those agency-backed mortgage securities, making their money on the interest rates spread. They are big, well-known players in the space that only pays monthly. That's why I like playing with these guys. But the story is the same. The risk isn't credit, it's interest rates. Their management team use complex hedging strategies to protect their book value. So you are trusting them to get it right. A sudden move in interest rates can wreck the books, and that'll destroy the values, and that'll destroy their dividends. So while they're holding it down, you've got confidence that the risk is worth the wait. As you can see, this isn't a set it and forget it portfolio. It's a finely tuned, actively monitored engine built for one thing: maximum cash flow. This is equivalent to fine-tuning your NOS after every fill-up. He says, sorry, I forget to let the audience know to subscribe and send money or don't get fed. Listen to Michael. Bayside threw me some. Reese Martinez, Telinia threw me some. I appreciate them for showing love on the podcast, because y'all gonna be making money off of this throughout the year. If y'all are following this channel, like and subscribe, and y'all see us every day, every Monday, Tuesday, and Wednesday. This is what we're talking about. We're talking about money being made in America, how the economy is changing through the laws, rules, and executive orders that change the way money is being made. Then we talk about ways that we're going to profit off the money on Tuesday. And then Wednesday, we talk about making money in other countries, because if you have money from other countries, you can go and live in another country. Here's one thing that I want to side note real quick. If you have money in another country, you don't need to bring luggage to the other country. You just need to leave your house with the clothes on your back, the shoes on your feet, and the damn ticket, because there's money over there. You can buy whatever you need when you get there. So carrying all that shit, Esteban, carry my luggage, fuck that shit. You can hop the plane with just the clothes on your back, and as soon as you touch down, the first thing you do is go buy you some new outfits. And if you've got enough money to cover a standard of living over there, you can leave the clothes over there where you're coming back with just the clothes on your back, saving hundreds of dollars on flight carrying luggage. I'm just trying to tell you, this works out in so many different ways, guys. This works out in so many different ways. Now, the yields are huge. And I'm going to tell you guys again that they come with a very specific and significant risk that you have to be willing to take on. And I am willing to take that risk. Now that you know what and why, let's talk about how. How do you actually build your own high yield portfolio? Now, here's the practical step-by-step process that I follow. Step one is a screening process. You want to find the candidates that you need, and you want to use a tool to scan the market for the stocks that fit your criteria. You can use whatever you want to use. You can use fintech apps. You can use, a lot of old folks are using Chat GTP, but y'all know that Perplexity is starting to outdo Chat GTP by a long shot and give you more detailed information. All you got to do is change the questions. Michael says, remember, I get 17% of everything you make. Going fishing. If you're getting 17%, YouTube is taking 50%. I'm gonna have to say, y'all gonna have to start throwing 150 at a brother so a brother can walk away with 50. But the tools that we're going to be using to scan the stocks, these stock screeners are going to be the most brokerage that we can find, and we're going to be able to see what we can do about using this information to get you guys what you need. So the stock screeners and brokerages that have them for free are the ones that we're going to be looking at. So here are the basic settings that I use to get my first list. First is dividend yields. You want to set the minimum of 8 or 10%. I set the minimum of like 15% because you notice none of my stocks were 14, 13, 10, right? We're hunting for big gain. And this will instantly filter out 95% of the market. Then we're looking at company type. I often screen for real estate investment trust or MREITs, mortgage real estate investment trust, BDCs, and other corporations separately to make sure that I'm comparing apples to apples. So I'm looking at 15% or up for each category and getting the best ones from each one. Then we're looking at price, and I always value price over everything else, because if you look at lower priced stocks under $50, not because they're better value, but because it makes it easier to accumulate shares. We have stocks that are over $100, like the Cord stock, which you see up above, it's like $106. But most of the stocks that we're showing you on the platform are under $25. We got a few of them over $25, but probably 70% of them are under $50 guaranteed. And this is going to allow you to compound faster, especially with a smaller portfolio. So for individuals that are starting out, individuals that are starting to expand, this is the best way to do it. Because if your shares are that low, under $50 a share, you can take the dividends from certain cash stocks and put them on buying more stocks somewhere else. Whether you re-up on the lowest ones or you add on to other ones, you are going to continuously increase your portfolio by using the dividends from the current stocks that you own. But by it being so much smaller, it is easier to do. So the first screen gives you your list of candidates, and now the real work is going to start. Step 2 is going to be the due diligence, separating the gems from the traps. A high yield is a warning sign just as much as it's an invitation. A huge yield often means the company is in trouble, but your job is to figure out if it's just a temporary storm or a sinking ship. You have to investigate why the yield is so high to avoid yield traps. Stocks with amazing looking yields that are about to get cut, that's the traps. Here's my due diligence checklist for every stock. The payout ratios. For most companies, a payout ratio over 100% means they're paying out more than they earn. A massive red flag. For BDCs and MREITs, it's more complicated. You need to look for at and look at things like net interest income, NII, or net spread. I'm going to tell you, this right here. I'm going to give it to you at the YouTube channel. This is what you guys need to be looking for: net interest income or net spread. And you'll be able to see if businesses is actually generating enough cash to cover the dividends. Your dividend history, which is what Michael was looking at. What is the track record? He went back 5 years on some of these stocks, showing that the value of the stock was so much higher. And I told you about how those same stocks had recently cut over the past year. But your current year over year, because you guys are just getting in, you want to know, have they paid consistently while also looking at their track record? Most importantly, have they cut dividends recently? So they've cut dividends within the past 2 years, but have they cut dividends within the past 6 months? A history of cuts tells you that management won't hesitate to cut it again when things get tough, which also means that for you, it's better to utilize that particular type of stock for a dividend rotation strategy instead of a buy and hold strategy. You can still use a stock though. Even when we're talking about stocks that have been on a decline from $30 5 years ago down to $6 right now, you're not trying to buy and hold some of the stocks I've been telling you about till it gets down to $5. You're trying to buy it, hold it till the ex-dividend date, sell it. If it drops $2 from the time you sold it till the time you buy it cheaper than what you bought it for before. That's what happens. Now, the financial health and debt is another thing that you want to be looking at. Looking at the balance sheets. How much debt are they carrying? For BDCs, you want to check those non-accrual rates that I mentioned before. For MREITs, what is their debt to equity ratio compared to their peers? Business model deep dives. If doing a business model deep dive, you have to understand how the company makes money. Read their investor presentations and annual reports. If you read those and still feel like you're reading a foreign language, walk away. Seriously. Don't invest in what you don't understand. But on the simplest level, if you understand that the stocks that I presented to you today have low cost to buy in and high interest rates on seemingly a monthly or quarterly basis, that's what you're buying in for. You're buying in for the monthly payouts first, and then your dividend rotation on the quarterly strategies until you feel comfortable with buying and holding the quarterlies. Now you're going to do portfolio construction. Diversification is going to be your shield. Once you have the list of companies that passed your checklist, you can't just dump all your money into the one with the highest yield. That's a recipe for disaster. While portfolios might be anchored by a massive yield from one stock, the rest of it must be spread across different companies and sectors to manage the risk. So here's my rule for building the portfolio. Never go all in on one sector. My example, my portfolio has the MREITs, BDCs, and a royalty trust. If interest rates spike and a crash, my MREITs, my BDCs might do just fine, cushioning the blow. You're weighting by risk. The riskier stocks is the smaller the position should be. So the riskier the stock is, the smaller the position should be, even if its yield is the highest, because you want to balance risk versus reward. Now, those of you that want to be riskier, you can put more money into the higher yielding stocks, taking a bigger chance, getting a bigger reward, but balancing off that reward would be taking the dividends from the high risk you took and spreading it across the rest of your portfolio to bring balance to the risk that you've already taken. The plan for rebalancing, which is what I just explained to you, is setting a schedule, maybe once or twice a year. I would do it every couple of weeks, every month. I will continue to look at these. You want to review your holdings and then rebalance. Rebalancing can be selling stocks that have appreciated substantially and then buying other stocks that are down. Rebalancing can be taking the dividends from all of your higher paying stocks and it's spreading them across all of your lower stocks, all of your lower valued stocks. This forces you to trim stocks that have run up and add to ones that have fallen, which is a disciplined approach that is crucial for long-term success. This three-step process, screen, vet, and construct, is the engine of this strategy. So you want to take the work that is required to do this, but this is going to be how your resilient cash flow machine is stabilized. The same way we got to tune up our cars, the same way, we've got to do a fuel treatment on the engine every now and again. You're going to see more results from more locations if you put more effort into your portfolio. Now, if you're following us and we're telling you what you need to do to make your portfolio successful, then you'll be able to do the exact same thing. Put more up there and get more back. Now, by the way, if you're finding this breakdown valuable and want to see more deep dives into high yields, I'm going to tell you guys again, you got to make sure that you subscribe to the channel. You want to hit the follow button on Twitter and Twitch, and you want to hit the subscribe button on YouTube, hit the notification bell on YouTube, because I put out new content every day and you do not want to miss what's next. Number 6, the secret sauce, turbocharging this platform with the dividend capture portfolio that we've been talking about. The tongue twister, dividend capture portfolio. For those of you who want to be more active, there's an advanced strategy that you can use to supplement your income. And this is going to be the dividend capture strategy that I've been telling you guys about for the past 4 or 5 months. The idea is simple. You're going to buy a stock right before the ex-dividend date and sell it shortly after. So if you own the stock the day before the ex-dividend date, you get the dividends. You swoop in, capture the dividend, get out. This sounds like a cheat code for free money, right? Steven has said, this is free money, bro. It's not necessarily free money. The market isn't dumb. On the ex-dividend date, the stock price will usually drop by about the same amount as the dividend. So if the stock is $50 and it pays $1, it will, on the opening day of trade of the ex-dividend date, drop down to $49. So if you sell right away, you are a dollar dividend loss, which is erasing your dollar gain, unless in situations where the stock rebalances and the dollar loss is still higher than your buy-in value. So the strategy only works if the stock recovers quickly or you bought in substantially lower, so that the lack of rebalancing of the stock does not impact your sell value. So there are going to be 2 big risks utilizing this. Transaction costs for those individuals that are buying and selling on platforms that charge you fees, because you're going to rack up a lot of fees that eats away at your profits. Tax implications, because these are going to be taxed regularly, because the qualified dividends are going to be taxed if you hold those stocks for more than 60 days after you bought it, 60 days before you bought it. But the dividend capture strategy is going to be holding it for a few days. And your much higher ordinary income tax rates will wipe out some of the small gains that you made if you're not making a substantially large quantity of returns. So this strategy, as a high effort, low reward tactic for some people, but it is not the secret sauce that they lean on. It's the secret sauce that we lean on, because we're getting substantial gains off of both the ex-dividends, and we're getting substantial gains off the sale, because everything that we're utilizing is on an increase. So we're benefiting from financial growth and we're benefiting from dividends at the same time. So your core long-term holdings is going to be the foundation. And then the ex-dividends on top might be the extra volatility that you utilize to gain you more revenue. So let's say you're using about 10 or 20% of your portfolio for the ex-dividend rotation. Then let's say that you're using about 40% towards some of the higher interest yield stocks. That's 60% of your portfolio. The other 40% of your portfolio is balanced out between the other lower interest, the lower yield stocks that you have in your portfolio, guaranteeing you a large return on a monthly and quarterly basis that you can add to your dividend rotation strategy. Now, again, if you're utilizing a minimal amount on your dividend rotation strategy, when your dividend rotation strategy gives you significant gains, you can keep that flat rate principal and take the dividends from that and spread it across the 40% of lower stocks, which still increases the growth of your portfolio. So let's say that you're doing this over the course of say, $10,000. If you use $2,000 for the dividend rotation strategy, $4,000 for your high-end stocks, and $4,000. If your $2,000 earns you an extra $1,000, you take that extra $1,000 and put it with the other $4,000 as the remainder. And your stock portfolio may gain an average 20%, where the $10,000 would gain $2,000. Well, the $8,000 might gain $2,000, but the $2,000 might gain $1,000, and that might put you at $3,000, which means you went from $10,000 to $13,000. You're welcome, but you took that $13,000 and put it towards the less riskier side, increasing the values of the 40% lower possession rate. Either way, you're looking at utilizing this particular method, the capabilities of either riding an average wave of about 35 or 40%, 50% return annually, or tripling your money with the high risk, high return for dividend rotation strategy. So can't end the live show without giving you guys the serious talk about that risk, because chasing that 27% yield is like walking a tightrope. The reward is going to be amazing, but if in the event that you're in it during the fallout, that fallout can be brutal. High yields exist because the market is demanding a high return to compensate for high risk. Forgetting that is the fastest way to lose a lot of money. So here's ironclad rules for managing your risk. The yield trap is your mortal enemy. A yield trap is a stock whose price has crashed, making the yield look huge, but the business is dying and dividend cuts is coming. So I'm going to say that again. A yield trap is a stock whose price has crashed, making the yield look huge, but the business is dying and the dividend cuts is coming. But you can buy for the 20% yield, and a month later, they slash the dividend by 80%, and the stock falls another 30%. That's when you got trapped. But if you bought it for the ex-dividend date, then you got rid of it, because they're going to announce slashes before it happens. If you buy and hold and you just ride the wave and just forget about it, you could get caught in these slashes. So if you only come back and check once a year or once every 6 months, you could get caught in some of these slashes. But if you're buying and you're checking every couple of weeks the stocks that you maintain, and notice each portfolio that I give you is not 200, 300, 500 stocks. It's like 5 or 10 stocks, sometimes 15. I haven't given you a portfolio that has like 25 stocks in it to monitor. But if you monitor all the stocks that I've given you on the show, you'd be monitoring 35 or 40 stocks. That's a full-time job. You want to spot these scenarios by looking for sudden yield spikes, and then the price probably crashes. You're looking for deteriorating financials or a company that's losing money but still paying dividends with debt. Then you want to look at the diversification, because this is not a suggestion, it's a commandment. So I'm going to say it again. Don't put all your eggs in one basket. Spread your money across at least 10 to 15 high yield stocks in different sectors. And that's one of the reasons why I give you 10 to 15 of them, but I don't give you like 30 to 50, but you can have 30 or 50. You have to monitor each one of them and be ready to make shifts whenever possible. But if you're diversifying in BDCs, M-REITs, and trusts, the failure of one company should never wipe you out. If a position like Misabai Trust blows up because their iron ore market collapses, the portfolio is going to survive because the income from the other sectors are stable. Know when to sell, though. In high yield investments, the idea of never selling is dangerous. That's why you're getting into high yields, because you're going to sell soon. You just got to see how long it's going to be before that happens. You need an exit strategy. So my rule is simple. And if the reason you bought the stock is no longer true, the stock should be gone too. So if you bought the stock because it was cheaper than its competitors, and now the stock is more expensive than its competitors, probably go ahead and get rid of it now because it has gained more value than what you bought in. If a BDC's loan book goes bad, I sell it. If the M-REIT's management team messes up, I sell it. You don't fall in love with a ticker symbol. Be loyal to your strategy and your money. The same way a coach is loyal to the playbook, not the players. You want to reinvest, but reinvest wisely. Compounding is where the real power is, but don't just automatically reinvest dividends in the same stocks. Pool your dividend cash and use it to buy whatever stock in your portfolio is the best value at the time. And that's what I was telling you a moment ago. So you can have a 60% high risk stock, high risk portfolio, and a 40% lower high risk portfolio. And you can take all of your dividends from all of your stocks and put more money into your lower risk portfolio, the lower risk side, to bring more balance to your volatile portfolio. Treat your dividend income like fresh capital to be deployed intelligently. This active approach to risk is what separates high yield investing from gambling. You have to be skeptical as an owner at all times. So you can really build a portfolio that pays 25% dividend base and get extra off of the dividend capture, which might put out 3 times more than that on a regular basis when you're not benefiting from the 168% across the board. So you can certainly assemble a collection of stocks whose current yields average out to that number. But that's just a snapshot in time, not a guarantee for the foreseeable future. So it's not easy, and it is definitely not as passive as people call it, but it requires a complete mental shift to a laser focus on cash flow. It demands that you explore riskier corners of the market, like BDCs and M-REITs, to force you to do more homework and become a true student of the companies you own. But most of all, it requires the unwavering commitment to managing the risk and diversifying while vetting your investments and knowing when to cut one loose. So the path for the cash flow capitalist isn't for everyone. We're typically providing this information for the individuals that are moderate to advanced. But if you're willing to put in the work, if you crave a real spendable income and you want that stream of income from your investments, and if you have the discipline to handle the risk, build a high cash flow portfolio, because this can be an incredible, powerful tool. And it's the strategy that changed my financial life. Because here's another thing. If you have a volatile portfolio such as this, and you're holding the percentage of your portfolio that you put towards a cash loan, then they can hand you a cash loan that you can pick up assets with, and then you can take your cash loans from, you can take your cash dividends and throw it towards that loan and not miss a beat. Now you could, instead of having a $500,000 portfolio and buying a $250,000 car, you can have a $500,000 portfolio and buy you a $20,000 car. But you bought the car cash up front. And if you have a ETF that has long spreads, they might give you 10, 15, 20 years to pay that back. You might take whatever you don't need to put on your bills and put it on that instead of boosting up your stock portfolio, which means you'd be paying the loan off sooner, but you own the car. Worst case scenario, they take your stocks. Best case scenario, you keep the stocks, but in every situation, you keep the car. Every situation, you keep the house. With the right approach, this has the potential to change your financial life. Now, I want to hear from you guys. What's the highest yield stock in your portfolio? And what's your biggest worry about it? I want you guys to drop that in the comments and let's talk about it. Because if you want to learn how to vet these companies and avoid these yield traps, you've got to make sure that you like and subscribe and come back to the channel, and let's have these open discussions. Because otherwise, you're going to be paying some stock option guru shit tons of money to not tell you any of the stuff that I've told you over the last hour and 45 minutes, that you got that information from me for free, and you get it from me for free most days out of the week. And they would have sold this information to you for a few $100s, a couple of seminars, a couple of retreats down the line, and then you had to join their membership so that you could get it off an exclusive website where you could have just came out here and got all the information that you needed with no effort. So with that being said, all the information that I've been giving you guys off the last 2 hours of the night show, hour and 45 minutes of tonight's show, we put all of the most valuable information in the comment section so you guys can come back and get it when you rewatch the show. Because the comment section replays in real time off of the YouTube channel. I want to make sure that I tell you guys, ladies, as long as the situation doesn't make sense, I'm going to keep asking you ladies to make it make sense. So ladies, please make it make sense. But fellas, this information that I'm giving you is to make you guys higher value men. So you must put in the effort because you will benefit from this. So ladies, this information is not gender exclusive. If y'all want to become higher value women, y'all want to be financially successful, you want to live off of the wealth that you have created yourself, because y'all don't need a man. Look, girl, y'all better take these stocks, go do y'all some research and start investing. Because while this can make you a higher value man as much as this can make a higher value man, y'all will no longer be chasing the rich guy with the bad intentions when you can be rich yourself. Now you're just looking for a guy with good intentions regardless of his wealth. Fellas, instead of y'all just looking for a girl that puts out, you find a girl that's got good financial sense. That way she's not wasting your money. And then y'all can grow together. Because I've told you guys plenty of times over the past 6 months that you really could. Two people with $50,000 a year income can live a $55,000 a year lifestyle and put away the other $40,000 and still be able to make themselves a millionaire couple inside of 5 to 10 years if they're not wasting the extra money. So there is no reason why anybody that's making more than $50,000 a year can't partner with somebody else that's making less than $100,000 a year and not be a millionaire halfway through their relationship. But that's why this and that, we talk about money on Monday, Tuesday, and Wednesday. We talk about personal improvement on Thursday, Friday, and Saturday. Because if you fix the negative things that's going on in your relationship, you fix the things that cost you money in your relationship. If you fix the way that you utilize money, then you'll have more money to utilize. The more money you have, the less you have to work for it. The less you have to work for it, the more free time you have. The more free time you have, the more free time you have to spend with your loved ones and stabilize and capitalize on those relationships. So this is a total package podcast. And it's very hard to find one of these. But now that you found it, take advantage of it. with that being said, tomorrow, Wednesday, we're going to be talking about a different country that we're going to be investing in. I want to give a special shout out to Bangladesh. I'm going to put them on the ticker tonight after the show. But Bangladesh, actually, yeah, because I got to spell it correctly. We're going to be putting Bangladesh up there because we got everybody else up there. They've been watching us. They've been watching us more than the United States this month. So I want to give a special shout out to Bangladesh. We're going to be talking about ways to live and invest in Bangladesh on Wednesday. And then after that, we're going to be giving you some personal development issues on Thursday, Friday, and Saturday. And then we're going to do our questions and comments on Sunday. So I want to thank you guys for coming to this and that. I'm your host, Xander, where we talk about this, that, and everything in between. And I will see you guys tomorrow night.
My network is my net worth. Choose your company wise. Surround yourself with eagles, not with sheep in disguise. Every interaction is a reflection of my brand. Quality over quantity, that's my personal command.